Welcome. It's nice having you here. Here at Lions Wealth, we talk about preserving, protecting, and enhancing your wealth as well as your wealth plan. Now, to that extent, there's a lot that we want to be talking about. My name is Nathan Crampy. I'm the founder of Lions Wealth Management, and I have my certified private wealth advisor license just to talk about some of the elements that we're going to be going through today. So with that, I want to dive into our first element, economic and stock market risks. Every so often, there's a massive amount of change that happens in a very short period of time. And last week was one of those weeks. So that brought a lot of economic and stock market just news to light and to really highlight a lot of different changes that are happening, and like I said, in a very short period of time. So the first one that we saw was the ISM Manufacturing Index, which is a crucial economic indicator, and it decreased to 46.7% in October. Now, what this is doing is indicating a slowdown and a potential challenge within the overall manufacturing sector. So again, by way of context here, when the index is falling and it falls below 50, it's considered contractionary or sometimes even recessionary. Now, it's because of this change that the Federal Reserve made the decision to hold interest rates steady for this month, and with a growing consensus that they may be done raising interest rates for now. Now, in addition, let's go back to that index that we were talking about. Let's also talk about the non-manufacturing ISM index, and that currently stands at 51.8%, which is just above that contractionary territory. So the next few months is going to give us a better understanding if we're going into a recession or not. And also the fact that with the state of the economy and how it relates to the possible recession is going to be the key concern of the bond market. Now, that's the other massive change that has happened. And due to the Federal Reserve's decision to hold interest rates steady, we saw one of the fastest drop in bond yields in history. So now this has ripple effects really all around not only the country, but the world. And then the US dollar depreciated significantly because of that as well. So bonds experienced one of the best days in history. And that is also something that we're witnessing, some extremes that are starting to occur. But here's the thing. Yes, bonds did well over the course of the week with the Federal Reserve's decision, but it's essential here to be cautious still, because even though the bond market is showing signs of stabilization, and especially on the long-term 20 and 30-year bonds that have been down and beaten down significantly this year, the Treasury still has to issue over $1 trillion in bonds over the next number of months, and this still may exert downward pressure on the prices. So it's not the fact that we're done yet with really signifying the all clear in bonds, but we're getting there. And it's not because of the fact that it is getting a better and we're having more people actually buy the bonds. It's because of the fact that we are becoming more recessionary with our numbers and the overall feel of the economy. So keep that in mind as you're starting to look at and make changes to your portfolio. But that also brings us to, the second section, which is portfolio changes. With changes that are happening quickly and pretty significantly, let's explore a couple changes we can possibly make in your own portfolio. Now, there's, like I said, these changes have been here to help adapt and evolve to the economic landscape. And we want to be taking a fresh approach and look at things like bonds. Now, this is to really help make things a little bit more palatable for what's been going on recently. Now, we have introduced and talked about in the past looking at 1 to 3 month and also 1 to 2 year bonds to really provide some short-term stability and taking advantage of the attractive opportunities. But we also want to do one other thing. Keep a close eye on the overall bond market. Now, if bond yields begin to fall faster than what they are doing and the US dollar continues to decline, this could actually be a really good time and a short-term positive momentum with the stock market. And if that actually happens, consider some really good stocks to add in. Especially some of the larger companies would work out very well here to add into your portfolio to seize some of these opportunities. Now, like I said, the changes are part of the ongoing efforts to optimize your portfolio and to really take advantage of the current stock market and the conditions that we're starting to see. So it could be a very short-term positive aspect. But like I also talked about, that the economic landscape is really changing fast. So be ready to make further adjustments if things really start to happen here. And we could also reintroduce possibly the 20-year and the 30-year bonds back into your portfolio. So this is another thought process here as well. And I'm not ready to say to have you look into those yet, but here's a glimpse that we could be looking at possibly in the future to help implement and to stay on course with respect to the bond market. And like I said, the ever evolving economic and market dynamics that are happening. So that's what we want to be really focused on, the fact that some of this could actually be short-term positive. But we're going to be talking about a couple other aspects in our next section here with regard to planning and overall wealth management, and it's going to include alternative investments, and they can actually help to increase your returns and potentially reduce your risk if done correctly. Now let's shift our focus to wealth management and advanced planning, and we want to take a unique aspect here as it pertains to your investments, specifically alternative investments and the potential to benefit and enhance your returns while reducing your overall risk. Now, alternative investments have been around for a long time, so think of them as real estate. That's a big piece of the puzzle. Then we can be talking about private equity, hedge funds, you name it. See, alternative investments are just that. They're an alternative to stocks, bonds, and commodities. So we can be talking about many different aspects like, well, paintings and wine. Yes, wine has actually been gaining a lot of attention recently and has been something that has been increasing in prices over the last number of years. And now, while we don't endorse a specific investment right now, Livex is really one of those wine trading places that serves as an excellent example of how alternatives can be integrated into your overall wealth management strategy. So this is a place that actually goes and highlights the different wines that are out there and starts to assign some value to them. So then we can take that and actually build alternative investments based upon that. So now you can actually own wine as part of your portfolio. So you may be wondering here, how can wine as an alternative investment really contribute to your overall financial well-being? Well, first of all, we're not talking about a $20 bottle or a $30 bottle that you just bought from the store. We are talking about the $5,000, $10,000, $15,000 bottles that are being traded, and some of them may be over $500,000 that are being traded around the world. Now, the one element to these is we deal with tax implications here, as well as many different elements of, well, how do we store correctly? How do we assign the overall value to that? And that's what we're talking about here. So this does offer some diversification, like I said, beyond just stocks and bonds. And that's really where this comes into place. So done correctly, it can actually help you to spread the risk and potentially increase your overall returns. Now, alternative investments are particularly appealing because they often are different than stock market dynamics. And they do sometimes lead to a level of protection against some of the fluctuations that you can see, which now can really be beneficial in the long run. So that's a great opportunity for you to explore with your own portfolio that may actually help you to achieve some of your financial goals. And that brings us to our second opinion service. I'd like to talk a little bit about what we offer here at Lions Wealth, our second opinion service, and this can help make a profound impact on your financial future. So our second opinion service is for you, and really what it's designed for is to make sure that you're in a good place and to give you just that, a second opinion on your overall wealth plan. Now, what we'll do is really arrange a discovery meeting to help understand your current financial situation and identify any gaps that may exist. Now, after that meeting, one of three things will happen. Either you're going to be in a good position and we'll let you know that you're in a good place and you don't need to make any changes. Or maybe there are just some small changes that you can implement on your own. Well, the last element here is that there may be actually some larger changes that are needed, and we may be the right firm to help you with making those significant changes. And what we'll do then is provide a comprehensive recommendations and strategies on how to not only correct, but to look at those gaps in different light. And this can involve making major changes like I just talked about, but basically what we're going to be doing is helping to ensure your overall financial future. Now, the service is about providing advice, yes, but it's also about empowering you to have informed decisions so that you can better your overall financial well-being. Now, that's a testament to our commitment to you and to your financial success, and also the success of those that you care about. So with that, let us know if you would like to have a second opinion service, and feel free to reach out at any time if you have a question. Take care.